And hello everyone, I'm Alice, the Greater China Specialist from Phillips Securities Global Market Desk. And first, thank you for attending tonight's webinar. For time being, if you have any inquiries during the presentation, and you can leave messages after this webinar, and I will answer the questions after the presentation. And today I will share with you the investment opinion for Greater China stock market and the US market. This is the outline for my presentation. I will give you a brief overview of the China's economic status, talk about the two sessions, which is one of the most important political events in China this year, and talk about the Hong Kong market characteristics, how the funds flow and what's the impacting factors, and what the investment opportunities in each market. And last, I will talk about the US market and give you a brief introduction about the Fed rate hike. And first, let's see the China's current macroeconomic situation, which are the fundamentals behind the financial market. The GDP, full name is the Gross Domestic Product. It is one of the primary indicators to gauge the health of a country's economy. And we could say from this chart that last year, China's GDP has reached to 74.41 trillion yuan, representing the 6.7% growth rate. And from the over 5-year statistic data, we could say the economy has registered a slower but stable performance. And it is worth to notice that the growth rate slowdown is only relatively compared to its own, but not absolute. So let's see. We could say that compared to most of the other economies, actually China has outpaced and contributed more than 30% of global growth last year. So China still maintains a high economic growth, and consider the objectives and achievements from the government. We are optimistic about the development of China economic this year. And next one is the CPI. CPI, the full name is the Consumer Price Index. It is one of the most frequently used indicators for identifying periods of inflation and deflation. We could say from this chart that the index has dropped to 0.8% year on year in February this year, well below the market expectation. And specifically, the food price fell sharply to minus 4.3%, while the non-food price fluctuating less. So obviously, the slump of the food price is the main contributor to the CPI drop last month. And the reason is at the end of the Spring Festival and the warm winter leading the decline of the food price. So therefore, the CPI declined faster than expected last month, mainly on seasonality, and we expected it will rebound in March. So the inflation pressure does not expire this year. And another economic indicator that most people concern is the unemployment rate. A total 30.40 million new urban jobs were added over the course of the year, and the registered urban unemployment rate stood at 4.02% at the year end 2006, which is the lowest level in years. According to the statistics, China has over 1.3 billion people, and nearly 55% are from urban. So it is not that easy to maintain the unemployment at this level and even decline. And the government has already set the target for this year, which 1 more million urban jobs are planned to create than last year, we could say. And if the targets are achieved, it will undoubtedly provide the strong fundamental support to the development of the economy. And let's move on to the two sessions. So what is the two sessions? This is the full name, the NPC and the CPCC. In Chinese, it's called 两会. It is the annual political sessions held in early March every year. At this time, China's top legislative and advisory bodies gather together to discuss and approve a national development framework. It is important to investors because in two sessions, the government set the tone for economic policy and will have a long-term impact on the equity market. And moreover, it will help to us to make the investment strategies. So first, let's see the key project targets for development this year. And the first rate, the economic indicators we have talked about. Investors do need to understand that the 6.5% of GDP target, which is 0.2% lower than last year, does not mean that the actual economic growth will slow down. The 6.5% is the bottom line, and we believe the government takes the initiative to cut down the target in order to leave enough space for the supply side structure reform and not be tightened by the GDP target. And the CPI target set to around 3%, which is the same with the last year. New jobs and unemployment rate we have already mentioned just now. And the reduction of at least 3.4% in energy consumption per unit of GDP. This shows that the government will continuously focus on the environment protection and the sustainable development of economy. And the last two is the fiscal policy and monetary policy. Based on the statistics here, and we could say that this year government showed the more proactive fiscal policy, while the monetary policy seems to be more prudent and neutral. And in addition, we know that the Chinese currency RMB faced with a lot depreciation pressure as the US dollar rose after the election. And Donald Trump even said would like to brand China as a currency manipulator. But from the two sessions, we know that actually the Chinese government wants to maintain the currency stability in the global monetary system and won't like to see RMB drop too much. And this chart shows the pledged fixed assets investment increase by province this year. Xinjiang, Tibet, Guizhou, Yunnan are the top 4 provinces. Especially Xinjiang increased even 50%. And compared to those blasting and developed provinces in the east, like Beijing, Jiangsu, these provinces are mainly located in the west of China with large area but least population, and their economies are relatively undeveloped. So it is reasonable for them to attract more investments from the government. What is valuable for investors is that most of these provinces are the neighborhood to the other countries, and it will definitely benefit the Belt and Road Initiative related enterprises. So let's see how can we make the investment strategies based on the two sessions. In two sessions, the Chinese Premier Li Keqiang has mentioned that the SOE reform will be one of the priorities of this year's government work. The SOE reform means the state-owned enterprises reform. The method is to change the shareholding system, allow the participation from the non-state capital and establish a mixed ownership system, which is in order to improve the efficiency of these enterprises. And it will mainly focus on these 7 industries, like the electric power, petrol, the gas, railways, civil, and the telecommunications. And based on the policies in 2 sessions, we have concluded the beneficial industries and concepts that listed on the slides, like the education and the healthcare, and the Belt and Road Initiative, the artificial intelligence, and the environmental protection. So let's move on to the specific sectors and stocks to see how does these stocks would be affected. First, in case that some of you don't know, not so clear about the China A-share market, and I will give you a brief introduction of the China A-share market. And we know that after Shanghai, Shenzhen, and Hong Kong Stock Connect launched, overseas investors began to have the opportunity to buy China A-share stocks. But not all the stocks are open for the overseas investors due to the big risk factors. And there are nearly 47% of the stocks are tradable through Northbound Stock Connect. And in mainland China, there are 2 main stock exchanges respectively located in Shanghai and Shenzhen. Most of the stocks in Shanghai are large cap state-owned enterprises, while more private companies choose to list it in Shenzhen. Nearly 20% of the Shenzhen stocks are high-tech companies, a much bigger proportion than that in Shanghai. And another feature of Shenzhen Stock Exchange is that there has 3 boards, which is the main board, the SME board, and the CHINEX. The CHINEX is like the Nasdaq in the US market, which mainly for the high-tech and startup listed companies. And right now at the initial stage, the stocks listed in CHINEX are only tradable for institutional investors for the risk factors. And in addition, when the stock's ticker begins with 6, it means it is listing the Shanghai Stock Exchange. When it begins with 0 or 3, it means it listing the Shenzhen Stock Exchange. And specifically, the CHINEX stocks begin with 3. So if you want to know more about the Stock Connect information, you can refer to our previous webinar on last December. Based on our research analysis, the following sectors and concepts are what we expected to outperform this year. And we have sorted out the related stocks in the table just for your reference. And all these stocks are chosen from the Shenzhen or Shanghai Stock Connect. First is artificial intelligence. This sector is gaining more and more attention from the people after the world-famous Go competition between Lee Sedol and AlphaGo, which is developed by Google. And China's artificial intelligence market grew rapidly last year, which is more than 23 billion yuan a year, with a compound growth rate of 26.3%. It will have profound impact on production efficiency and economic development. And this year in the 2 sessions, the artificial intelligence was first written into the government work report. Correspondingly, it has a significant influence on the stock market. For example, After investors heard the news in 2 sessions, the artificial intelligence related stocks rose to a great height in the market. And we could say that these are the 2 stocks have raised the 10% daily limit and led the sector. After that, the sector has outperformed of the indices and became one of the hottest concepts in the market. The yellow one is the Shenzhen Component Index. Okay, let's move on to the next. The next one is about Road. So what is the Belt and Road Initiative? The full name is the Silk Road Economic Belt and the 21st Century Maritime Silk Road, known as the Belt and Road. It is a development strategy and a framework proposed by Chinese paramount leader Xi Jinping that focus on connectivity and cooperation among countries, primarily between China and the rest of the Eurasia, which consists of 2 main components: the land-based, the Silk Road Economic Belt, and ocean-going Maritime Silk Road. And this year, the Belt and Road Initiative will continuously be one of the most important projects from the government, especially after Trump won the US election. China needs to seek more diverse external demand to hedge weakening US demand caused by the trade protection. And we could say that China has won many big achievements last year, which on the slides. China has, the enterprises from China has signed the new contracts with 61 countries, and which increased 36% of the money this year. These are the related stocks that we could say the most stocks are in the construction, oil, railway, port, and shipping. Many of the companies hold the largest market cap in their own sectors. For example, the first line, the CR Corporation, is actually before last year, it's actually the 2 companies, and after that it has been merged, and it became one of the largest market cap in the A-share market, especially in the construction sector. Another one is the SOE reform we have just mentioned. The bloated state-owned enterprises, which account for 40% of China's economic output, have less return rate but more favorable treatment than private enterprises. As China's economic growth slows, the SOE reform is clearly necessary. For example, the China Union Group was included in the first batch of pilot companies. For example, the China Union Group was included in the first batch of pilot companies for the mixed ownership reform, and it has become the leading stocks of the SOE reform concept in the stock market. Okay, another 2 sector we thought is the healthcare and white spirit. The healthcare we have just mentioned, it has been affected by the government project this year. And the white spirit, it is a feature of the A-share market. The related stocks have drawn much attention from global investors, and there are many high-quality companies with good performance, like Guizhou Maotai. Its stock price has just hit the all-time high record this week and become the most expensive stock in A-share market. And another one is the traditional Chinese medicine, the TCM. It's another unique sector in Asia market. Many of the companies have the investment value because its scarcity, like Yunnan Baiyao, one of the most famous Chinese medicine product. And this company is also under the SOE reform. And the last one is the environmental protection. As we mentioned, China has paid much more attention these years to protect the environment because the bad air quality in the big cities, and we could say a lot of enterprises is related to the environment protection. Okay, and for the Hong Kong market, and first let's see the Hong Kong market characteristics. We make a comparison with the world indices of the average PE ratio with the main countries like the US, Europe, England, France, Germany, Japan, China, Asia, and the Korea. The valuation of Hang Seng Index is very low, and that means the stocks in Hong Kong market have the investment value with cheap prices and potential growth. And from the slides, we could see the market structure in the Hong Kong stock market. The market capitalization and the turnover value, which the mainland enterprises count for more than half of the total stocks in Hong Kong. It has been divided into H-shares, the red chip stocks, and the mainland private enterprises. And for the investor structure, we could say that the number of retail and institutional investors are similar for local investors, but for overseas investors, the institutional ones count for much higher proportion than retail investors. And in general, overseas investors and institutional investors are in the leading position in Hong Kong market, which differs from Asia market. In addition, in Asia market, the proportion of retail investors is more than 80%, and most of them are local investors. And let's see the investment opportunities in Hong Kong market. Firstly, the Stock Connect related stocks. As we know, like the overseas investors can only buy the A-share stocks through the northbound South Stock Connect. Not all the Hong Kong stocks are tradable for the mainland China investors, and they can only buy the shares through the southbound Stock Connect. We could say from the chart that most of the time the cash flow is above the zero line, and that means after the launch of the Stock Connect, more funds from mainland China flow into the Hong Kong market, and this actually have a big impact on the related stocks. And the three stocks are first adjusted into the Shenzhen and Hong Kong Stock Connect for this day. Received the sought after from mainland investors immediately, and this made the price rise sharply. And all of these three companies are well known among people who live in mainland China, like Zhou Heiya, Meitu. But the high profit always accompanied with the high risk. And for example, the company Meitu, it's actually a new share just listed in Hong Kong Stock Exchange last December. And we expect the extreme fluctuation of the price was caused by the capital speculation, because the boom of the stock price did not get any fundamental support from the company's profit, since it's still losing money. But except May 2, most of the Stock Connect related companies have good operational performance and with large market cap. We have concluded the 20 stocks by turnover for your reference here on the slides. And for the AH share premium, and we know some of the enterprises were both listed in Mainland Stock Exchange and Hong Kong Stock Exchange. The A share means in Mainland market, while the H share means in Hong Kong market. So the premium means the price difference between the A share and H share with the same company. Like here said, when the premium is positive, that means the H shares price is higher than the A shares Hong Kong equivalent price. And we could say from the chart that the premium below the minus 20% occupies more than half of the proportion, and thus means most of the stocks were undervalued in Hong Kong market. So we have listed some of the stocks that rank by the premium gap, and we saw that with the same company, the H share price is much cheaper than the A share price. After the Stock Connect open, actually the price gaps are getting smaller, and we expect the H share price of these companies will be more expensive in the future. And we are also positive to the stocks with a high dividend yield, since Hong Kong market is more mature compared to A share market. So the traditional valuation methods are more effective. Here we have calculated the average trailing dividend yield for each sectors in Hong Kong market, and these are the top three sectors, which is the utilities, telecommunication, and the real estate. And after that, it's the consumer sectors and the financials. And moreover, we have considered the factors of low PE and PB ratio, which means a low valuation and the large market cap. And these are the top 20 stocks with the dividend yield higher than the Hang Seng Index average. And we expect these stocks have the long-term investment value. And we can say most of these stocks were in the sectors we have mentioned. And then let's move to the Fed rate hike. The Fed probably plays the most crucial role in the U.S. economy and in the world economy. Yet most people have little idea how the Fed works, what it actually does, and why its decisions have so much impact. So let's first break down the basic jargons used when talking about the Fed. The Fed, the full name is the Federal Reserve System. It is the central bank of the United States. It regulates the country's financial institutions. It's composed of a network of 12 Federal Reserve banks and a number of branches. This is all overseen by the Fed Board of the Governors, a group of bankers who make important decisions. It's important to note that the Fed is an independent agency, which means it can make decisions on its own without needing approval from any other branch of the government. And for the FOMC, we usually heard about, this is a group within the Fed that makes a decision. The FOMC stands for the Federal Open Market Committee, and this committee meets 8 times per year to set key interest rates and to decide whether to increase or decrease the money supply. The FOMC consists of 12 members, the 7 members of the Board of Governors and the President of the Federal Reserve Bank of New York, and 4 of the other 11 Reserve Bank presidents. After they conclude their 2-day-long meetings, they release the results of whether they decide to raise or lower or not change the interest rates. The next one, very important phrase, is the federal funds rate. The Federal Reserve sets monetary policy by influencing the federal funds rate, which is the rate of the interbank lending of excess reserves. This is the interest rate that banks charge each other for overnight loans of federal funds, and which are the reserves held by banks at the Fed. And this rate is actually determined by the market and is not explicitly mandated by the Fed. The Fed therefore tries to align the effective federal funds rate with the target rate by adding or subtracting from the money supply through the open market operations. And another one we usually heard about is the Hawkish and Darvish. This is typically Wall Street lingo and jargon that is meant to both confuse you, might be confuse you, but also save people time explaining themselves on the trading floor. And you can think of these 2 words as a bullish or bearish analogy for stocks. But in here, it applies to the interest rates. The central bankers are decided as hawkish when they are in support of the raising of interest rates to fight inflation, even at the cost of slowing economic growth and employment. The dovish central bankers, on the other hand, generally favored economic growth and employment over raising interest rates. They also tend to have a more passive stance when reacting to an economic event or action. There are 3 main tools of monetary policy that the Federal Reserve uses to influence the amount of reserve in private banks. The first is the open market operations. It is a principal tool for implementing monetary policy. The open market operation allows the Federal Reserve to increase or decrease the amount of money in the banking system as necessary to balance the Federal Reserve euro mandates. The open market operations are done through the sale and purchase of Treasury bills. The Federal Reserve buys Treasury bills from its primary dealers, and the purchase of these securities affects the federal funds rate. Because primary dealers have accounts at depository institutions. And the second one is the interest rate. And the interest rate change to commercial banks and other depository institutions on loans received from their regional Federal Reserve banks. And this rate is generally set at a rate close to 100 basis points above the target federal funds rate. The idea is to encourage banks to seek alternative funding before using the discount rate option. And the third one is the reserve requirements, and it is also known as the required reserve ratio. The amount of funds that a depository institution must hold in reserve against specific deposit liabilities. That means how much banks need to hold in deposits against lending the deposits out. So the Fed always uses these 3 tools together to promote sustainable growth, high levels of employment, stability of prices to help preserve the purchasing power of dollar and moderate long-term interest rate. So let's see what happened. The U.S. Federal Reserve voted to raise interest rate for the first time in this year at its two-day FOMC March meeting, which concluded on March 15th. The move was widely expected and is a sign of the economic strength. The U.S. Central Bank will raise the target range for the federal funds rate to 0.75 to 1%. This is the third time the Fed has raised interest rates in the last decades. And the last time the U.S. Central Bank voted to raise interest rates was last December. The Fed's update projections can be read as a signal that there is still going to be more than one rate hike in this 2007, and the media of committee members' predictions is that the federal funds rate will be 1.4 by the end of this year, which would mean 2/4 point increase this year. Let's see why the Fed raised the interest rate. When the Fed makes the decisions, we usually consider about the following three questions. The first, how many people want jobs? And during an economic recovery, the number of people who cannot find work gradually dwindles, and employers start chasing applicants, wages start to rise, and the Fed, worried about inflation, start raising interest rates to prevent the economy from overheating. More than 7 years into the current recovery, the unemployment fell to 4.6% in November, a historically normal level, but the rest of the picture doesn't look quite right. The unemployment figure counts only people who are actively seeking work, but millions of adults remain on the sidelines. By keeping rates low, the Fed could draw more of those people back into the workforce, but labor market conditions are tightening, wages are rising, and policymakers increasingly are worried about the overheating. As Ms. Yellen said, if the Fed were to delay increases in the federal funds rate for too long, it would end up having to tighten policy relatively abruptly. And the second question they care about is how low are the interest rates? The Fed cut its benchmark rate by 5% points in response to the Great Recession. That is 5 points of stimulus. Fed officials are increasingly convinced that it has become more like 3 points of stimulus. Global interest rates are in a historic swirl. The problem can be described as a glue of money or an absence of attractive investment opportunities. One consequence is the narrowing gap between the market rate and the Fed benchmark rate. That means the Fed is providing less stimulus than it thought, which in turn means it doesn't need to pull back quite so quickly, since it doesn't have as far to go. And the third question they care about is what damages is done by doing nothing. The Fed usually increases rates because it fears inflation, and the inflation remains sluggish, in part because of the weakness of the global economy. But Fed officials have other worries. Notably, they're worried about creating future financial crises. The low rates are intended to encourage financial speculation, but too much risk taking is not a good thing. And the longer rates stay low, the greater the risks. The Fed officials have heightened some areas, like commercial real estate, but they are also worried about the problems they cannot say. After all, the next crisis usually came from a different place than the last one. The fear of the unknown has become a major argument for moving more quickly to raise the benchmark rate. But mistiming a rate increase has consequence. If the Fed moved too soon, it could derail what remains of the economy expansion. And if it waits too long, it could be forced to hit the brakes even harder. So in summary, right now, the Fed thinks the economics indicators have been pointing an economic that nearly full employment and inflation seems to be firming up despite being weak last year. And let's look at the performance of A-share stocks before and after the rate hike. And we can see that historically there is no strong correlation between the Fed rate hike and A-share market performance. And A-share still run in accordance with their own regulation operation because China's stocks market is dominated by the local and retail investors. It is relatively close to overseas cash flow, although after the Stock Connect launch, the influence from the overseas capital seems to be increased a little. And there are many factors could have impact on the A-share stock market. The Fed rate hike is only one of the small factors. But for the US market, let's see, in the past 6 rate hike cycles, except the 1994, the stock market reaction is positive. In the interest rate cycle of 1994, it is because that the time of the market did not fully reflect the expected rate of the interest rate situation. The Fed in the short term raised interest from 3% to 6%. The most affected is the bond market, and the stock market also has been implicated. And the main reason for the stock market general performance in this rate hike cycle is that the interest rate hikes are positive affirmation of the economic fundamentals. In this case, the negative effects of the high interest rates on the market trend would be diluted by the positive effects of the economy. The Fed has also learned experience from the year 1994, and they are gradually strengthening the transparency of the monetary policy implementation and pay attention to the communication with the market in order to avoid scare the market. So sum up the historic experience, the interest rate itself does not necessarily have a negative impact on the stock market. What investors should be concerned about is, the first, whether the rate hike is a reaction to the economic strength or to suppress out of the control inflation. And the second one, whether the market expectation to the interest rate hike is consistent to the Fed's real interest rate increase. And the third one, is there a potential bubble in the market? So after the Fed raised rate on the March, and we saw the US stock rose, the Dow Jones Index hit a 6-day high record. And the main reason is that the global capital market has made full of the expectation coupled with strong economic data, like we just explained. And we know all major indices of the U.S. Continuously reaching new all-time high after Donald Trump won the U.S. election last year. In the belief of a deregulatory financial system, and the spending and a huge tax cut for American corporations created almost a perfect scenario for America to be great again. But last Friday, after weeks of continuous negotiations over the American Health Care Act, the Republicans had to admit defeat as they could not gain sufficient support from their own side for the plan to overhaul U.S. health insurance. And the worries from the investors have already reflected to the stock market. And the Dow Jones has just made the largest weekly decline this year. And so the mad rise of the indices has been fundamentally supported by the sound economic data and outperformed annual reports, although we are still worried about the market is too optimistic right now. We are expecting markets to head towards euphoria conditions soon, and euphoria are usually associated with market peaks, and we do not expect it to be any different this time around. However, the question remains on how long such euphoria can continue, and one of the biggest risks of U.S. market right now might be the gaps between investors' expectations and the real market valuation. So that's all for my presentation. For more information, you can refer to our website or our research reports, private in the poems, and some of the stocks I mentioned today have been already covered. And in addition, we have also have our own official WeChat account. You can just scan this QR code or search these Chinese characters in the official account to become the follower. To those who followed our WeChat account this month, we provide the lucky draw opportunities to win the iPad Air 2, and the deadline is at the end of this month. And for WeChat account, we publish the Chinese market updates and the stock research reports every day. And you can also contact us directly through leave the message on it. So if you have any questions on today's webinar, and you can leave messages to me. I have to end today's webinar. If you have more questions, you can leave us the email and we will contact you after it. And thank you all to attend today's webinar. Goodbye.